how you all are doing? Let's have another discussion today in continuation with the video that I have just posted last, that is on efficient market hypothesis. So friends, we are going to see that how efficient market can be again subdivided, or in other words, what are the different forms of efficiency. So just a quick recap, we have already seen what is an efficient market. We have seen certain characteristics. The first characteristics, that prices are random, stock prices are random, and therefore there is no pattern. Anyone cannot make extra profit by learning the historical price data to predict the future. We have also seen that our stocks are correctly priced. Correctly priced in the sense that we have the market value which is exactly equal to the intrinsic value. So there is no imbalance between market value and the intrinsic value. We have also seen, friends, that in an efficient market, the price reflects all data. Whatever information are there, price reflects all information. Prices reflect all available information. Whatever information, whether good or bad, is immediately adjusted. So price adjustment is very immediate. Any good news or bad news coming from the company gets immediately passed on to the market, and the price accordingly adjusts instantly. Okay? And therefore there is no possibility of extra profit. No one can beat the market by doing any kind of analysis. So what is that analysis? No technical analysis, no fundamental analysis is possible under efficient market, right? So this is a very important point. Why we do technical analysis and fundamental analysis? We do technical and fundamental analysis so that we get a clue about how the stocks have behaved in the past, and based on that we want to predict the future. But in efficient market, we believe that there is no such possibility that the stock prices can be analyzed or can be studied to know their trend, to predict the future, because the stocks are totally random. So prices are random. Now friends, if this such situation prevail, then we say the market is efficient. Okay, market is efficient. Now friends, but there are some flexibility, some kind of relaxations, and according to that we have got three categories of efficient market. Okay, three categories of efficient market. That is, we say that the market can be weakly efficient, it can be efficient, or we can say strong efficient. Market is strongly efficient, and semi-strong market. In between we have semi-strong form of efficiency. Weak form of efficiency, we can say weak form of efficiency. We can have semi-strong form of efficiency, and at last we can have strong form of efficiency, strong form. Okay, so these are the types of efficiency, market efficiency. Types of market efficiency. So friends, you can see I have categorized three types. One is weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. Let's understand what is the strong form of efficiency. Strong form of efficiency is something where everything is true, where you find that the prices are random, stocks are correctly priced, prices reflect all information, there is no chance for extra profit, there is no technical analysis and fundamental analysis. Then we will say that the market is strong, strongly efficient. Okay, strong form of efficiency. Now let's understand what is the weak form of efficiency. In the weak form of efficiency, friends, we have seen that technical analysis and fundamental analysis is actually not possible if the market is efficient. But in the weak form of market, what we have seen is that technical analysis means chart analysis. So it is not possible. Chart analysis is not possible. But you know what is fundamental analysis? Fundamental analysis is EIC analysis. Please follow my previous video on what is fundamental analysis. Under fundamental analysis, we do economic analysis, we do industrial analysis, and we do company analysis, because as an investor, when I am investing, I am trying to study the economy as a whole, I am trying to study the industrial performance or the industrial scenario as a whole, and then I try to find out the company profile. I try to see what is the balance sheet, how the financial statements, all these things I take into account before I make the investments. But you might agree with this point that this information I will get from public documents like annual reports or any other documents that is published to the public. So economic, industrial and company analysis requires public documents, or we call it, these are public information. Now these information, I don't know whether you believe or you agree or not, this information are not available to everyone at the same point of time, because there are some bottlenecks. Some will receive them early, some will receive them late. Right? Some of the reports come to people very instantly, but some reports come to some category of people late. So whenever there is a delay in the passing of information, or whenever there are bottlenecks to access the information freely at a point of time, then there are people who can take this advantage. I got to know the annual reports earlier than you, so I can understand what is going to happen in the market before you. So I can make extra profit before you react. So that means here in the weak form of efficiency, I can make use of public information which is not evenly been passed in the market. There is some kind of, there is a time lag that some people do not receive it in time. So that's why, since public information is not available to everyone at the same point of time, there are people who get this advantage, and with the using public information they can make extra profit, right? So that means in this type of weak form of efficiency, fundamental analysis is possible. So fundamental analysis can help the investors to make extra profit. The assumption is that, or the belief or the argument is that public information do not receive to everyone at the same point of time, but they believe that technical analysis will not help because prices are random, right? So what is weak form of efficiency? Weak form of efficiency is based on the argument that the fundamental analysis requires us to gather public reports or public information, and to some extent the public information, there is some bottlenecks that some people do not have the accessibility at the same point of time. So those who have got the prior accessibility, they take the market, they beat the market by making extra profit. So that's why this type of market, where there is a little time lag of receiving the public information, you can make use of fundamental analysis to make extra profit, and that market is known as weakly efficient market, or we can say weak form of efficiency. Let's move on to semi-strong form of efficiency. In a semi-strong form of efficiency, what happens that they believe that fundamental analysis is of no use, technical analysis is also of no use, public information is also of no use. Okay, that means when the market is semi-strong, that you cannot make use of fundamental analysis also, there is no need for technical analysis also. Okay, that means they believe if the market is semi-strong, the argument is that public information has reached to everyone. We cannot make this argument that some are receiving early, some are receiving late. No, if the market is semi-strong, then public information cannot be made use of. You cannot take advantage of public information because everyone has the same accessibility. So that's why you cannot do fundamental analysis, and technical analysis of course is not possible. Then how can I make extra profit? So semi-strong market says that there is something called private information, or we call it insider trading. Okay, public information you understood. Now let's understand what is private information. Private information means insider's information. Someone inside the company is having the first-hand exposure to some secret information. He leaks this to someone to whom he favors. So, if I have a relative, I might tell him go and purchase shares because tomorrow the price is going to touch the peak. So, this information leakage is private, not public. So, private information may be passed to the market and some people can take advantage of it, and that's why you can make extra profit. And that type of market where public information is not the cause of making extra profit, but private information is the cause of making extra profit is known as semi-strong market. Right friends? Let's go to the strong, and that I have already told you that these are the situations when neither fundamental analysis is possible, nor technical analysis is possible, not public information is of any use, no private information is any use. So that type of market is known as strongly efficient market. Exactly what is been highlighted here, right? So friends, we have seen in this video that what are the different forms of efficiency. In the previous video I have explained you the concept of efficiency. So I do have a full-fledged video also, you may refer to it. The description box will contain the link of that video. We will meet again in the next video, and where we will test how can we know whether the market is efficient or inefficient. Okay, so friends, we will see there are certain tests that we can do for understanding what type of efficiency the market is in, whether it is a strong efficient market or it is an inefficient market. So thank you for watching. Bye bye.